A new stock market trend has become evident in 2025, and that is trading range. Trading range that has been characterized by acute moves and sharp reversals. Now, we've seen these in both the daily and weekly charts, both of which we'll go over today. So as we know, a new trend like this is not detectable in the early stages. We need to see a number of things repeated a few times before a new pattern or behavior becomes evident in the charts. And really, this first started in early December here, December 6th, when the S&P 500 hit our 6,100 target and then began to fade. And again, we know that in those ensuing days, not much really changed, kind of stayed near those highs. But after the FOMC hawkish cut on December 18th, the character really looked different, right? That was led by some downside follow through, a sharp advance, another big pullback, another big bounce, and so forth and so on. And each one of these times, of course, both bulls and bears got encouraged that the next big move would continue in their favor. And of course, that has not happened. So as we start the day here on Tuesday, January 21st, testing 6,000 once more and getting very, very close to that upper line once again. So if this looks familiar, probably should, because if you go back to 2023, we had a similar looking range or downward sloping channel take place from the August highs or July highs here down to the October lows. And the same type of thing. The initial pullback didn't really seem too ominous because traders that were hesitant to buy too much after an extended move like this were trying to be patient. And once that initial bounce came, it was very encouraging. In fact, I would argue that it looked encouraging even to the middle of September, because at the time, we were actually profiling a potential cup and handle pattern that was looking like it was about to be completed. That, of course, did not happen. The bottom fell out once more, and the ensuing bounce didn't even get back to the upper line of this channel and back down to the October lows. And so once buyers were not immediately rewarded a few times, it wasn't really too encouraging even when the October low hit. So we had that initial bounce, very strong over those first few days to few weeks. And the market got all the way back up to 43.75 was resistance, back to the uptrend line. Again, buyers were still under the impression that this would fail as well. So people weren't too encouraged just yet. And what happened? Big breakout occurred and continued. And of course, that has led to where we are right now. So of course, the question again is, what part of this trading channel is the S&P 500 in currently? Is it back to testing and failing at the upper line that we saw, say, in August and September of 2023? Or is this been enough? Is this been enough of the market finally digesting a tough trading environment and getting ready to blast through this zone? And of course, 6,100 and new all-time highs will be right after that. Now, one argument, of course, is that the S&P was down 11% over a 3-month period. So we had a much bigger drawdown over a longer period of time that kind of washed out the system. Right now, not so much. The S&P is down about half of that from its all-time high. But don't forget, many other areas got hit a lot harder and a lot faster. We reviewed the RSP equal weight S&P 500 ETF last time. It was down about 9% in a very short amount of time. And we can even argue that XLB Materials ETF and a few others also suffer a lot of pain. And so they have been due for a bounce. Next part of that bounce turning into something more substantial, one thing is extension, of course. The other part of it is potentially having a higher low, which of course we know is the beginning stages of a bullish pattern. Now, also, we can look at the MACD. Now, the MACD, as we know, has been very useful over the years at detecting key trading lows and key trading highs, depending on what market we're in. Now, we reviewed this in the past from a sell signal perspective, and we've had a number of MACD sell signals hit over the last 2 years, and the majority of them have failed. And that's not a surprise, considering what type of market that we're in. Uptrending markets tend to not reward mean reverting move indicators that suggest big rollovers. Of course, that was different in 2022 when MACD sell signals worked very, very well. Now, buy signals, though, have actually done well both in bull markets and bear markets. The only time that the MACD buy signal, as we can see here, did not immediately pay dividends was in the early stages of the bear market in 2022, And then again, in the same time frame we just reviewed between August and October 2023, where these initial dips, of course, ended up being head fakes, not the type of strong buys that we saw in the months before that. But since that point, right, since the October low in 2023, MACD buy signals have done very well and have come right after key trading lows. Last two, of course, back in May 2024, and then again in August 2024, and now again potentially in January 2025. So the same concern, is the market now oversold enough to reward another MACD buy signal, or are we in this initial part of a head fake where we're due for more downside or at least more of a trading range? And if nothing else, using the MACD as a gauge to tell us that will be very important to see over the next week to 2 weeks. And so that's the daily work. We've also seen reversals on the weekly charts as well. So last week, in fact, the S&P 500 logged a pretty substantial weekly bullish engulfing pattern, which came immediately after the weekly bearish engulfing pattern that we reviewed in the last video. Right? And so this doesn't happen too much. And as we mentioned back then, what is key to any potential pattern? Seeing follow through. Well, the S&P was up 4 out of 5 days last week, had a positive breadth near 70% each of those days. So there was an emphatic stance by traders looking to get long instead. So remember, when we talked about the bearish engulfing patterns last time, 3 of the past 4 marked key tops. The question was this close enough to be considered a top? Or again, do we have enough of a pullback that this is actually going to lead to upside follow through instead, like it did near the lows in March 2023 and October and November 2023 as well? So let's go back to see the last time that we had a weekly bullish engulfing pattern follow a weekly bearish engulfing pattern, and that was in June 2021. So as we know, that was in the middle of a very strong year, and that came after the big reversal from COVID lows in 2020. And so obviously buying after this bullish engulfing pattern, again, which came after the bearish engulfing pattern, was a good choice. You got about 6% gain to the September highs here, and then of course, a little bit of a dip, and then a rally to the end of the year once more. So as we know, 2022 did happen, but if any one of these times where we threw the towel in just because there was some sort of negative reversal without any downside follow through, of course, would have been the wrong call. So that's why we're waiting to see how we'd have some sort of potential follow through to the last bearish engulfing pattern on a weekly basis. So far, it has played out like we saw in June 2021. And so again, these were the times where we had bearish engulfing patterns in 21 and in 22 that did not lead to downside follow through. So it has happened in the past, and it's something we at least have to pay attention to as we go forward. And so looking at the 2-year trading channel, again, we are moving higher, of course, but it's the S&P has been oscillating within this trading channel, and more recently in the upper half of it, right? And so we talk about this all the time, where we see the biggest amount of selling come after the S&P has hit the upper line. But as we can tell here, 6 prior times we saw the market have some sort of demand near the middle line, and 5 out of those 6 times, the ensuing rallies were strong enough to then pull the S&P back up to the upper threshold. The only time that did not happen, surprise, surprise, that same period in 2023, this was August, the initial rally into September failed, and then we had the second part of that down leg, which of course took us to the October 2023 lows. So now there's 3 different examples where we're potentially comparing now to what happened from August to October 2023. Will we end up having the exact scenario where we need another leg down or 2 before this is over? We shall see, of course, because now we've had a very strong move with very solid breadth, as we know, which was missing in December, which is now here with us now. Will that be enough? The rotation is here to take us back to new all-time highs with, of course, a new presidency taking hold and getting into the thick of earnings season right now. We're also continuing to watch the weekly moving averages. Last week, that bullish engulfing pattern happened right as the S&P was testing that 26-week moving average. Last time that happened, September, just a few months ago, and that led to 2 more months of strong movement as well. Now, we've discussed this in the past too. The weekly RSI has been making lower highs. So it's been showing us, it's been exhibiting a negative momentum divergence on a weekly perspective. However, that has been in place since March of last year. So again, something to keep in mind. It's a warning sign, but paying attention to this instead of focusing on price action, of course, is not the right thing to do. So always have to remember, this is something that is a potential negative, but as long as we see the RSI hold near that 50 zone, that's much more important. And that is really what has supported this rally, from that perspective. And of course, patterns. And so we came into last week with the potential of this bearish pattern breaking all the way down and achieving its downside target near 5,600. That, of course, did not happen. We spent one full day or close below just one day during that initial break. And of course, it didn't hold. So as of right now, it just looks like another failed pattern. And we'll continue to track this as it continues, which then means that the 6180 mark continues to be in play. It was not tested at all when we had that big rally from last week. And then another way of looking at the trading channel from that first chart is it could just be this, bullish falling wedge pattern. If we look at this on a weekly basis, we can even classify it as a potential bullish flag pattern as well, or just a consolidation phase that's downward sloping that we've seen before eventually get resolved to the upside. And then lastly, of course, this all could just be classified as one big trading box. In fact, one of the biggest trading boxes we've seen since we started classifying the price action in this way, with the potential bearish pattern being broken, also turning this into a huge bear trap, which of course, as we know, when we have false breakdowns, the moves in the opposite direction are sometimes even more severe and telling from that nature. So the next step, of course, would be to break above this trading box. And if we did get that breakout, that would point to new highs and beyond. That's what we have for today. Don't forget to check out these videos and subscribe. And I'll talk to you next time. Thank you.